Happy March. I'm Valerie Leonard, founder of EverThrive Financial Group, and our team and I hope you're enjoying the transition to the spring season and the extra daylight from moving the clocks forward. It's only been a few weeks since our last update on February 24th when we posted an update on the market reaction to news out of Russia and Ukraine. And today we're going to take a look at what's happened since then and what you might expect for your money going forward. As always, at EverThrive, we're here for any questions you have. While we meet regularly with our clients to review their plans and talk about what's new in their lives, we're also always available for questions when geopolitical or economic events trigger unexpected volatility in markets. So feel free to lean on us as a resource. Our theme this month is lion or lamb, based on the saying, March comes in like a lion and goes out like a lamb. That saying actually refers to the weather, but does that saying also refer to the markets this month? So let's find out. March definitely came in like a roaring lion with late February volatility and a market correction, which a market correction is defined as a decline of 10% or more. So the market correction since its January 3rd peak this year has definitely been swift. We saw the Dow Jones Industrial Average see drops of 600 points and then 800 points. And February was the second consecutive month with losses in all three market indices. Now, markets were already selling off due to concerns over rising inflation and interest rates, and then continued to do so in response to news of the conflict in Ukraine and the global sanctions imposed on Russia. And as of Friday, March 11th, the S&P 500 was down about 11.5% since the beginning of the year, and the NASDAQ, which primarily represents technology stocks, was down roughly 17.8%. And a lot of investors have been heavy in tech for the last few years. So you can imagine we're seeing lots of volatility out there. But what does all of this mean, especially for you and your money? An important rule of thumb for investors is to keep in mind that it's all about fundamentals. So we track all kinds of things in the stock market, but at the end of the day, we really want to go back and understand what is happening when you open up the hood and you look underneath what's going on with our economy. And it's all about the fundamentals. So just as ABCs, for example, are fundamental to reading, there's also economic fundamentals that give us a more accurate view of what's ahead than short-term market shocks. Plus, strong fundamentals support the markets through times of short-term volatility. Now, consumer spending and retail sales are two of these fundamental economic indicators. And so what the arrow points to here is the highest month of retail sales that we have seen since March 2021 stimulus checks spurred consumer spending. These better than expected retail sales have helped to offset December declines that occurred due to the Omicron variant. And this recent data is definitely encouraging. More good news was that there was a significant decline in the COVID-19 cases, and the 7-day moving average showed the lowest number of cases since July 2021 before the Delta and Omicron variants. So while we certainly can't predict the future variants, experts believe that medical risks will remain low, and job news is also very positive. So with a new pandemic low unemployment rate of 3.8% and 678,000 new jobs added in February alone, the jobs market is looking pretty strong. Business spending is also another indicator to watch. So it's not just the rate or the amount of spending that we watch, but also what are businesses spending their money on. And durable goods orders increased last month, which typically indicates business investment. That's a good sign, very positive sign for potential growth ahead. And for our latest What We're Watching update, we will continue to follow what happens with Russia and the impact of sanctions, even though the overall impacts to the U.S. market are likely to be just temporary turbulence. The S&P 500, which is shown here, the S&P has been interesting because the earnings scorecard for fourth quarter of 2021 showed that 76% of companies that make up the S&P 500 have reported a positive earnings per share surprise, and 78% of those companies have reported a positive revenue surprise. So that's all great. But for first quarter of this year, the estimated earnings growth rate for the S&P 500 is 4.8%. So if 4.8% is the actual growth rate for the quarter, it will be really the lowest level since fourth quarter of 2020. And personally, I would not be surprised if growth slows even more than what analysts are expecting. No major concerns here, but it's something that we're going to keep our eye on closely in first and second quarter of this year. Lastly, on this slide, the 200-day moving average is an important technical indicator. So that's this red line that you see here, and this is the average price of the S&P 500 going back for 200 days. And a lot of this speaks to behavioral patterns and human emotion, but this red line can signal changing investor sentiment when the market trades below it. All three of the major U.S. indices finished well below their respective 200-day moving averages due to volatility. So we're going to be watching whether or not investor sentiment starts to change or whether we go lower. So the 200-day moving average is important, but you also want to look at the 200-week moving average because it represents a longer period of time and gives us, for most long-term investors, kind of a better picture of where markets might be headed, especially for retirement investors over their working careers potentially. So if you look at the 200-week moving average instead, you're going to find that we are still trading significantly higher than this red line, which may indicate that if we can hold up in this current area, the worst may be behind us. But if conditions deteriorate, the 200-week moving average and other levels that are not really pictured here on this chart may serve as support for markets. So right now we're holding up, decent given everything going on throughout the rest of the world. Now, in summary, the February and early March markets remind us that we can't always predict what's around the corner. And of course, unexpected risks can rattle the markets. But even though those risks create volatility, they are not typically a good indicator of longer term risks or of the underlying fundamental conditions. So right now, the fundamentals are still solid. It's painful to have your accounts down. I understand that. Pretty much every investor out there right now is experiencing losses in their portfolio through their employer-sponsored retirement plans or outside investment accounts that may not be retirement money. But there's probably going to be continued volatility, but I don't believe it's a long-term concern. So as an investor, you're going to want to know what your risk tolerance is, never take more risk than you're comfortable with, and make sure that your investment portfolio is aligned with how much risk you're comfortable taking. If you don't know if this is the case for you, email us at info@everthrivefinancial.com and ask us for a complimentary risk assessment, and we will let you know. We will be back next month with more news. If anything major happens between now and then, I will do my best to record another video. But until I see you next time, know that we are working hard at trying to help all of our clients thrive. And we hope that you are doing well, and we'll look forward to talking with you soon.